Hi there, I'm coming to you from quarantine land as we continue our non-class existence. And I'm wearing hunter orange in honor of safety, to promote safety during this time. So be safe out there, try to avoid large groups, etc. And I'm trying to do that as well. Yeah, my hunting partner hates this hat. I do like the wide brim though, blocks sun from all the angles, and I just don't like baseball caps that much. But my river hat looks better, I think. So let's continue our discussion of life insurance, and this will be part 2 of that. So I'm going to get to where we left off, which was right after this slide. So we're going to talk about a few different types of life insurance. Briefly, we're going to mostly focus on term insurance, and there's a reason for that, because, well, that's the only one of these major insurance products, the type of products that I would recommend buying. So I am going to talk about whole life and mention universal life, and we're going to compare them to term insurance so that you're prepared for the sales pitches that you would get from insurance salespeople. Insurance people are not most likely going to try to sell you term insurance. What they're going to be selling is the other products, and you can guess why. Well, because they make more money on those in general, a lot more money. So term insurance, all term insurance does is provides you coverage. It pays out whatever the amount of your policy is if you die during whatever your policy period is. So just like if you buy auto insurance for the year, if you have a wreck during the year, your auto insurance pays. If you have term life insurance, you get paid if you, well, your beneficiaries get paid if you die during the term. Question here, what happens if you stop paying the premiums or if you die? Let's say you have insurance that covers you through the end of this year. If you die January 2nd of next year, well, you don't get anything. So insurance, term insurance pays out if you, the insured, should happen to die during that term. It does absolutely nothing for you if you die outside of the term, just like, again, car insurance, home insurance, health insurance. If something happens after your period that you paid for is up, well, you're not covered. Why am I going into detail on that? Because that's one of the pitches on whole life, or one of the things they'll try to say is a flaw with term insurance. So, what value do you get from a term insurance policy after your policy is up? Well, you get absolutely nothing. So you could pay into your term insurance policy for 20 years, and if you're still alive at the end of 20 years and you quit paying, well, you get absolutely nothing. That's just the way insurance works. I've had home insurance for a long time, 30 years, more than that, and, well, I've never collected anything. Does that mean the home insurance was a ripoff? Well, no. It provided protection in the event that I had an issue. So if my house had burned down or been blown away in a hurricane, then I'd be provided coverage. Since that didn't happen, well, I didn't get a payout. Doesn't mean insurance was a bad decision, because I didn't want to face, a significant financial loss that I would have if one of those events had occurred. So with term insurance, there is no savings benefit. All you get from term insurance is protection in the event you die during that period. So how long is the term in term insurance? Well, the answer here is it depends. You get to pick. So there are different policies with different lengths of time. You can name your period of time for the most part, And well, you can pick a longer period of time and cancel earlier. But you can lock in different things, different rates and coverages over different periods of time. So maybe a 5, 10, 15, 20, or 30-year term, depends what you want. So last term policy I got, well, actually, let me see. I don't think I can. Here you go. Oh, no, that didn't work. I was going to see if I could, oh, well. I had a picture on my screensaver on my other screen. I was going to see if I could show you, but pops up a picture of my daughter as an infant. Well, actually, it did move a little. Sorry. Let me see if it keeps moving. No, it just moved it out of sync there. Sorry. Anyway, so the last term insurance policy I had, I picked to last until my daughter graduated from grad school. I assumed when she was little that, hey, she'll go on to grad school, and picked a policy to last that long. So you can set the term that you want for your policy. So don't lose too much sleep over these different choices here, but know that you have a variety of options to choose from. So one option here, the multi-year level term, you pay the same premium. So you lock in, here's what you're going to pay, $600 a year for the next 20 years, and you get the same coverage over that 20-year period. Now we know if you're collecting this, if you're going to collect $1 million this year versus $1 million 20 years from now, that $1 million 20 years from now would be worth a good bit less than $1 million today. So even though you have the same payout amount, it's not going to be worth as much in the future. That's one thing to keep in mind with a policy like this. Decreasing term, the premium stays the same, but your coverage decreases as you age. Geez, why do you want a policy where your coverage decreases in addition to that inflation decrease you get above? Well, typically we think of our insurance needs declining over time. So remember last time we saw one way to decide how much insurance you need was how long until your children reached the age of 18, or maybe you could I picked 25, I guess, like I said, for grad school. As you get closer and closer to that time period, your needs would decline. So you wouldn't need, as your children get closer to going to elementary school, you wouldn't need as much daycare coverage. As they get closer to graduating from high school, you wouldn't need as much miscellaneous expenses, etc. So that's one reason for the decreasing term insurance. Another option here, your coverage stays the same. You don't lock in a premium amount, but you get whatever the going rate is as you renew. What I had was the multi-year level term, the last policy I did. So I wanted to show you some examples of some rates of these policies. Let me drag this over. I think this should drag over nicely. So this is from Easy Quotes for You. Anyway, I just found this because they had nice tables. So roughly rates right now, if you're a 30-year-old male and you get 20-year term insurance, you lock in your policy amount for 20 years, and you have the same premium, same amount of coverage for 20 years, you could get $1 million policy right now for roughly, we'll say $50 a month. $600 a year gives you $1 million in coverage. That's for a non-smoker. Now, ladies, you could get a same $1 million policy for maybe $10 less or so. So you could lock in that for $480, depending on which one, or less, depending on which of these policies you got if you're a female non-smoker. Now, of course, we know the older, so we know, we'd said this before, males are at higher risk of dying in any given year than females, so that's why we see the higher costs for males. We also know as you get older, your probability of dying increases. Real pleasurable topic here. But as you get older, your probability of dying increases, so your costs will go up. So here with the same protective agency here, pop back up here for the 30-year-old male, he would have to pay $47, $48 a month. The 30-year-old male would pay that. The 40-year-old male would end up paying about $68 a month. So, a good bit of increase there. Female, still less than the males, but higher for the 40-year-old female, higher than the 30-year-old female. Obviously, as we get older, rates are going to get higher. So 50-year-old male, there's the 40-year-old male. This is for a 20-year policy. The 40-year-old male is paying about $60 a month. The 50-year-old male is paying $170 a month or so for insurance for the same 20-year policy because, well, a 50-year-old male, average life expectancy, there's a good chance the 50-year-old male might die in the next 20 years, considerably less than for a 40-year-old. Oops, that was a female. So 40-year-old male up here at $68. And of course, you get on up here to a 65-year-old. A 65-year-old male wants a life insurance 20-year term, $910 a month. So $12,000 a year for $1 million in insurance. Still, that's a good bit less than the million, but this again is rates a preferred non-smoker. So one thing I should mention here, this preferred bit assumes you're in good health. So this isn't going to be a 30-year-old with diabetes and high blood pressure and a heart condition. This is going to be a 30-year-old pretty healthy non-smoker. Likewise down here, this is going to be a 65-year-old in prime shape, not a 65-year-old with a whole bunch of health issues. Let me drag this way. All right, yeah, so back what I've just mentioned about preferred health rates. So we got our guy here. I'm not going to comment on him. You really need to be careful where you post your photos. But anyway, so I am using you giving credit for this photo. So will I have to get a physical to get life insurance? You be the insurance company executive again. Would you want him to take a physical here before you give him insurance? Or are you going to give him your best rate, or what are you going to give this guy? Well, most insurance policies require some kind of medical check, either a physical of some type and or a review of your medical records from your physician. So they're going to ask you to have your physicians send in your medical records because they want to know, do you have type 2 diabetes? Do you have cancer? Do you have high blood pressure? Whatever. If you have any of those, your rate, your premium will be much higher than if you are healthy. Oh, so yeah, let me back up. If you did find some policy that said, hey, we take anybody, no physical required, what can you guarantee about the cost of that policy? Well, if it's a policy that says, hey, no physical required, come on in, you can guarantee that that's going to attract unhealthy people who are afraid what the physical would show. So the policy is going to be priced as though you were in the worst health risk. So healthy people would not want to get a policy that didn't require a physical. One exception there would be policies through your employer, which if everybody's insured, they don't require a physical because they're looking at the averages, and you generally have that as a benefit through your workplace. But extra insurance through your employer, be careful about that. I actually I don't usually make coffee, but I made coffee this morning, and I may have made decaf. My wife wasn't happy with me about that. All right, so I said we were going to also talk about whole life insurance just a little, and again, don't buy this. That's my recommendation. Just don't buy it. And there may be a case where you've maxed out every other retirement option you have and some other things, and then you might think about this, but anyway, that's low down on the list there. So, but whole life, what is whole life? So it's designed to, they sell it as, this is insurance that you buy and will cover you for your entire life, and it will include life insurance should you die early. But unlike term insurance, where you pay into it, you might pay for term insurance for 40 years and then you quit getting it and then you die later, you'd get nothing payment-wise from term insurance. So if you lived with whole life, you get a cash value that you can take out early, or ideally if you bought this product, you would keep in there until you retired. So there are different payment options with it. So again, whole life has two pieces, an insurance piece and a cash value piece. The sales pitch will be, geez, don't you want to get something out of your insurance? Have something at retirement? Term life doesn't do that for you. So your cash value with a whole life policy increases over time because, well, you're putting money into it, and it is also growing. It's like a lot of other tax-deferred retirement type plans that we'll talk about later. Your income, you don't get taxed on your income in the account as it's earned, but you do pay taxes when you take money out. If you take money out before age 59 and a half, I don't know why the half is in there. That's just the IRS. You pay ordinary income tax plus a 10% penalty. So, but anyway, so you don't want to cash out of these things early. But again, you don't want to get into one in the first place. So the cash value of a whole life policy increases over time because as you pay your premiums, part of the premium goes towards death protection, your insurance policy, and over time your policy builds up a cash value. So with a $200,000 whole life policy, if you kept it a long time, it would have $200,000 in value that you could take even without dying. Well, not dying sounds good, but I guess it's not kind of a, you don't really have a choice long term, but in the short term, I'd rather postpone that. So yeah, here, can I cancel the policy, a whole life policy, and take my cash value? Yes, but again, penalties, and the life insurance part would end. So I mentioned this already, but with term insurance, you don't get anything if you don't die. With whole life, you get savings that you can spend. So, geez, I'd rather have a cash value and not die. So what's the catch? Well, I'm sure you can guess the catch. It costs a whole lot more, and there's a whole lot more fees in there and a whole lot more commissions for the salespeople. You don't want to buy whole life insurance. What you should do instead is buy a competitively priced term insurance policy from a high quality provider, and just do your retirement savings separately where you have more control over it and there are not as many fees. I've got a link here to one of the personal finance so-called
video cue. Let's go to
gurus here. She's a little on the more not my style here, the psycho style of, I guess you get more clicks if you're extreme. Hey, even I'm doing gimmicks today with my orange vest. But so here's one of the people you can search for her. If you search for personal finance books or whatever, you'll find her as one of the she has a bunch of books out there. But anyway, so let's do a quick video of her talking about term insurance versus whole life.
Catherine in Salt Lake City, Utah.
Good evening, Susie. I'm married with 2 young children. Our financial advisor signed us up for variable life insurance on my husband. We pay over $600 a month with a death benefit of $750,000. We've had it for 6 years, and I've never felt comfortable about it, and I'm wondering what we should do.
What you should do, first of all, is get yourself a new financial advisor. That's number one. You know, Miss Orman here has a top 10 hate list of investments that she hates. And she hates them because they...
Well, this is an older video down here, you can see, but the all the notes still apply here. And note here, variable life, that's a category of another cousin of whole life, only benefit the person who sold them to you. Well, they'd get the biggest benefit. I'll be quiet now.
Literally do absolutely nothing for you, and they do everything, in my opinion, for the financial salesperson that sold them to you. And variable life, universal life, whole life insurance, that's probably on the top of Miss Orman here's top hate list. So, the only type of life insurance that you should have, in my opinion, is term insurance. Insurance that's good for a specific period, a term, usually until your youngest child is 23 years of age. $650 a month for $750,000 of insurance. Do you know, with a 20-year level term policy, let's say you were in your 30s, you could do that for $50 a month, not $650 a month. And then you could take that $600 and do what with it? Put it into a retirement account. Insurance was never meant to be a permanent need. It was only meant to be there during your younger years in case something happened before your assets built up. Here's what you need.
That's an important note. So again, insurance, life insurance, not a permanent need for the most part. Remember, we had in the last part, I forget, the 65-year-old retired couple who were saying they're multimillionaires like you plan to be in the future. They no longer had a need for life insurance, really.
To do. I want you to get yourself a 20-year term insurance policy in place. Then cancel your other insurance. Never, ever, ever cancel insurance until the new one is in place. And like I said, get another financial advisor. All right.
Well, yeah. So that's just a different take on, basically the same, agreeing with me there on the lack of value for whole life and other policies that other than term. So term insurance is the only type of life insurance that I would also consider. Oh, so I have, yes, drag this back over. So whole life insurance, this is that same page where I was showing you some quotes a minute ago. Whole life insurance rates. Let me go back here to our, see, we're not even getting much in coverage here. So let's say you need $1 million worth of coverage. You decide you need $1 million worth of coverage. Oh, heck, that's not even, they're not even putting it on the scale because the price is so much. So our 30-year-old male here, we said it was going to cost about $50 a month for $1 million in coverage. Now, here for $180 a month, our 30-year-old male can get $250,000 of coverage from whole life. So what if we can only afford $180 a month? Would our insurance agent say, geez, you really need $1 million in coverage. You don't want whole life. No, odds are they're going to say, well, here's the most expensive policy you can afford is this $250,000 in coverage. So you're big time underinsured if you had $1 million need. Again, what Ms. Orman said in that video we just saw is take your $50 a month, put the rest in a retirement account. So anyway, that's whole life there. They're going to and they don't even, so multiply this times 4, and that would give us an estimate of the $1 million policy, $720 a month for $1 million in whole life insurance. Again, that's versus 50. So that's $670 extra for this whole life policy. It's going to, well, you'd be better off to do the $50 in term life, put the rest in a retirement account through your employer or one of the other options we'll talk about later. These things are loaded with fees, and people who have them, I've got this popping up, tend to be underinsured because they can't afford to get as much insurance as they need or want, because these things are so expensive because of the savings component, which has more fees than what you get where if you invest, where we'll talk about later. Universal life, just another cousin of whole life. You don't want this either. Okay, variable life, whole life, universal life. You don't want any of them. So I'm going to back up here. It was further back than I thought. There you go. Back to this thing here. I am going to ask you some questions comparing these coming up in a sec in this presentation and also on the test. The only reason I'm asking these is so you know when the insurance agent is trying to sell you something that it's not what you want. You're going to want, hey, I just want the insurance that covers me for a period of time and costs a lot less. And I'll do my retirement saving on my own, thank you. And again, that'll be coming up after test 2. So, term insurance versus whole life insurance. Which one is pure insurance? In other words, which one gives you just insurance coverage and nothing else? That's term insurance. So term insurance, the only one you want. You're covered for a period of time. If you don't die during that period of time, I'm betting on you, you don't get a payout. What do you get when term insurance is up? Nothing. That's not bad. Again, you don't, if you pay for a year of auto insurance and you don't have a wreck, you don't go and ask the auto insurance company, what are you giving me for my money? They gave you that peace of mind and financial protection if something happened during that period of time. If nothing happened, your policy, something happened to somebody else, so that's how insurance works. You pool all this money and they pay out to the small percentage of people who have events. And you're just lucky to not have been one of them. So term versus whole life. What does whole life give you in addition to death protection? Well, that savings piece or that cash value. But again, it's overpriced. So that cash value that you'll get, this will be again the big sales pitch. And some of these salespeople selling this actually believe this is a better product. They've gone to training through their companies and they're brainwashed into, hey, this gives you a cash payout. Might also be, recognized that, hey, this gives them the bigger commission too. Much, much bigger. Well, obviously, if you've got a product where the insured is paying in $720 a month versus paying in $50 a month, the person that sold that is going to be happier with the $720 a month. So, which term versus whole life? People who buy this type of insurance are more likely to be underinsured. I already answered this question here. Whole life, because back to our 30-year-old male, married with 2 children. If they needed $1 million of insurance and their insurance agent only quoted them whole life, $720 a month. Well, what if we can't afford $720 a month for insurance? Well, then we'd get less coverage. And we could probably afford the $50 a month and be fully covered. So whole life, yeah, anyway. So, so anyway, what I said before is buy term insurance, put money in your retirement accounts. We'll talk about those later. There is no, what whole life insurance is really two products. It's insurance and it's an investment product bundled together and with a sales pitch. There is no need to bundle those two products. Do you get a cash payout when you buy car insurance at the end of the year? Do you get a cash? I actually saw a State Farm policy that said you get your insurance, your premium amount back, or you get something back at the end of the year. And that was basically, all that basically meant is they were going to charge you too much up front and give you something back. But anyway, so you should not bundle these. Here's Dave Ramsey is another one of these personal finance gurus. I'll skip his deal there, but you can watch that. He also hates whole life insurance and prefers only term insurance. He's a little bit of a grumpy kind of guy. Anyway, so another way you can get insurance is you may get life insurance through your employer. I think my sister said she gets 1 or 1.5 times her salary in life insurance from the company. The state of Florida used to have something like that, and then they dropped it to just $25,000 in coverage, which is kind of lame. But this was some places, again, this will be a benefit that you get through your employer. With these, that's one, and this will all be term insurance. Once you quit working through your employer, unless you paid something extra for a short period of time, your insurance ends. So this is only term insurance that covers you while you're employed. Oops. Yeah, so do you have to take a physical for group life insurance? This is through your employer. No, they don't require a physical for this. The reason for this is because everyone who works at the company is employed, and the insurance company picks a rate that averages out for that company. So they know based on experience from that company and such, and the demographics and such, what they're going to charge for the company. So the company is paying a rate that covers the average employee. So in this kind of deal, if you and I were both employed at the same company and we both got $50,000 of insurance coverage, I'm actually getting a more expensive benefit than you are, because $50,000 of insurance for me at age 58, having to remember how old I am, is more costly than for insurance for you. At most of you guys are younger. What are you guys, 20? Some of you older, some maybe somewhere in that area. But anyway, so I'd be getting a more expensive benefit than you would if you're younger than me. But they price for the whole group. And also health conditions not checked. Someone who's not healthy is getting a more expensive benefit than someone who is healthy. So again, company pays based on the averages. Let's say you've got insurance through your employer. Should you get increased coverage through your employer? Well, it depends. So younger people, you could check the prices of added insurance through your employer. So you can get more insurance easily through your employer. That's one nice thing. You just go on and click a few boxes at the beginning of the year, or actually when you have your annual sign-up period. I think ours is like in October or something, October or November. We have to make those decisions for the following year. So real easy. You just click a few boxes. But it may not be the best priced insurance. You need to shop around for that. So it is definitely worth shopping around, especially for younger people, versus just getting more insurance through your employer. Now, who usually gets a better deal in group life insurance? Well, we know that men should pay more for insurance, but hey, with group life insurance through your employer, everybody gets the same life insurance. So, well, men are getting a better deal here. So women should pay less. Maybe, anyway, we're all getting the same benefit. So, men are getting a better deal there. I talked about credit life insurance before with, I think, home loans and auto loans and credit cards. So all those things are going to offer you credit life insurance. So, hey, don't bother signing up for term life insurance. Just check here on this box when you're getting your loan, and what this insurance will do will be pay off your loan if you should die during the period of the loan. These are horrible, horrible deals for the most part. So this goes with my back here, things never to do. Don't buy whole life insurance. Don't buy universal life insurance. Don't buy credit life insurance, because who makes the most money on this? Well, the place selling it and then the insurance company. These are overpriced products that people buy because it sounds good at the time and easy to check a box, and we just add something to your monthly payment. Shop around, get term insurance that would cover you. You get term insurance that would do all this: pay off your home, pay off your car, pay off your student loan debt, do more for your family, and all at a much lower price than what you'd get from this garbage. So I mentioned this before as well, but remember, a beneficiary is who gets paid in the event of your untimely death. So my beneficiary is my spouse. But if we are in a tragic canoeing mishap, actually we're safer on the rivers than we are on the road. But if we were in a tragic mishap, both of us together, so my beneficiary is gone, well, I have a contingent beneficiary. So I only have one kid. So she is my, no fighting over this, she is my contingent beneficiary. So if we're both gone, my daughter gets paid. And, well, if we're all gone, then the funds would go to my estate. And then we've got, do I have anybody named beyond my daughter in my will? And I guess we actually do have the clause there that it gets divided per whatever family members, so it would go to split to sisters and etc. Or, well, I say sisters because I don't have any brothers, but anyway, so it gets split among siblings. And then anyway, so there's rules on that. So, but it would, your life insurance, just because your beneficiaries are gone doesn't mean the life insurance doesn't pay out. It will still pay out. It just will go be split per your will or per state law if you don't have a will. Well, everybody does this every once in a while. If you send in your payment late, will your policy be canceled? No, you generally have a grace period. And sorry for that. So you generally have a grace period in which you got to get your payment in with, say, 30 days, or it will be canceled if it doesn't come within that grace period. All right. So suppose you lied. You said, hey, I have no conditions. And I don't know what condition it is you have, but you lied when you filled out your application and denied that you had a condition that you did have. Will the insurance still pay out if you die? Well, there is generally a period of time, this incontestability clause, that depends on the policy and such, but if you die after that period, maybe 1 or 2 years, then even if you lied on your policy, you will still be covered. Let me see. Well, there is a an exception to this. So let's say you had, I don't know, cancer that wasn't picked up in the physical, but you knew you had it, and you said no cancer on your application. If once 2 years have passed, even if they find out and can prove that you knew about this condition, the insurance policy would still pay out. So the incontestability clause, that limit is passed, so you're okay. But there is an exception. So to this incontestability clause, this time period, if you were guilty of fraud, let's say I had an evil twin brother, and well, I don't have any twins or brothers, but let's say I had an evil twin brother who had cancer, and he wanted to get an insurance policy, and I went to his physical in his place. So I got the check out and all, and I checked out good. And then down the road, my evil twin brother dies, and they go to pay out his policy and find out that I actually showed up for the physical. In that case, they do not have to pay. Well, back, the moral of the story is, well, don't be like this hidden woman here. Don't lie on your application, and if you do with fraud, they won't pay out, but if something else goes on, once you pass this period, you're safe. So if you know someone who did lie a while back, they're probably safe now, but let's not do that. Oh, here, another thing don't do. If you can't rush out and get an insurance policy, then kill yourself. Don't kill yourself anyway. We've got counseling and stuff. So, please don't do that. Yeah, sorry, this is such a cheery topic. But generally after 2 years, policy pays out regardless, but don't do that. I'm moving on because I'm already tired of that topic. So you can get some extra clauses on your term insurance that, well, of course, extra clauses are going to cost extra money. So, if you're disabled, waiver of your premiums. Yeah. If you died as a result of an accident, you get double. Well, I mean, why do I need a double payout if it's because of an accident, not because of the coronavirus? Sorry to bring that topic in. So this one I'm not keen on. If I think I need $2 million of insurance instead of $1 million, let me just get a $2 million policy, not double it up if it's because of an accident. We buy a policy and you lock in no matter what. Well, you can lock in with the term policy for the long period. Anyway, so don't worry about most of these extra choices here, but there are some options. This one, the accelerated benefits, this one could have some value here. There are people that have terminal illnesses. They know they're going to, and this may be in force in your policy. You just need to check if this is an option. So you're going to die. This is again, cheerful topic. It's just a matter of time with your terminal illness. There are some policies that may go ahead and pay out now, so you can extend or enjoy or cover costs now, so you aren't, anyway, it could be of a benefit to you to get paid out now versus, waiting a year or so till after you die. So that's one possibility there. The payout on your insurance, you have choices generally on how you get paid out. You maybe take equal payments over time, lifetime income, interest only. Well, most people will just take the lump sum, and then you can invest that however. One thing to note, if you do have a loved one who dies, check with their employer. They'll generally get with you, but do make sure that you collect on any work-related life insurance, because Most employers would likely have some life insurance built in as a benefit that you wouldn't even have to pay extra for. All right, so what you want is term insurance, forget the other options, from a reputable insurer. And you want term insurance at a good cost. This isn't like, hey, I want to pay for premium term insurance. If you get a safe, sound insurance company, you want the best price you can get from a safe, sound insurance company. So one way to do this is shop around, and one place to shop around, like with everything these days, is online. So here are a couple places where you might shop around for quotes. One thing you want from companies that you find through these sites here or other places would be high quality ratings from a reputable rating agency. So these are some companies that rate insurance companies, among other things. Standard & Poor's is a big name in stocks and bonds, and so is Moody's. Anyway, so there's some rating agencies that will rate insurance companies, and you want companies with nice, safe, secure ratings, and these will be available at these via these sites. You can get ratings on these companies. So, life insurance, again, not a cheerful topic. I guess it's fitting for these coronavirus times. Sorry to bring that term up. But you want this to cover your loved ones. Again, for the most part, you get nothing out of it personally, other than, well, by that I mean you aren't going to get the cash payment because you'll be gone. But what you're doing this is a personal values kind of topic. So you're buying a product that gives you no direct benefit, but it will benefit your family, most likely, partners and such, in the event that you leave. And you get this if there is someone who is financially dependent upon you. If no one is financially dependent upon you, you probably don't need the product. So, in term insurance, the only insurance you want to buy of the life insurance options. So, and yeah, get however much coverage you need. Don't be underinsured, because term insurance is relatively inexpensive. As we saw right now, or roughly about now, a 30-year-old male non-smoker in good health can get $1 million in coverage for about $600 a year. And this is $600 a year that you don't expect to collect on, but if you have a family that's dependent upon you, this is the product to get. And with that, we'll end our discussion of life insurance. Holler if you have questions. I know you don't see me face to face, but drop me an email.